Good morning, good afternoon. Welcome to the panel that I am so excited to be hosting, The Road to Renewal. We're going to talk about PGIM's best ideas for 2022. I'm Lisa Abramowicz, and I got to say, this has already been quite a year. I hope it is going to be the road to renewal after a pretty rocky start to 2022. It's such a unique moment in economic and market history, from inflation taking off in ways that we have not seen for decades, from emerging from the most disruptive health crisis going back to the 1918 Spanish flu. People rethinking how they want to engage with environmental, social, and governance issues. And we are so lucky to have a stellar panel with us to talk about the potential trades within all of this. Joining us is Cathy Marcus, Global Chief Operating Officer and Head of U.S. Equity at PGIM Real Estate, Garvin Smith, Head of Equity Research and Portfolio Manager at PGIM Quantitative Solutions, and Brian Thomas, who is the Head of Energy Finance at PGIM Private Capital. Let's begin and talk about this from the high-level main issues of the year, starting with, frankly, the shift into the post-pandemic era. Hopefully, once Omicron is gone, we can actually get there. Cathy, let's start with cities, because there was so much talk last year about the exodus out of big cities and the shift to smaller urban centers as people avoided the pandemic. What are you seeing right now in terms of that migration?
It's interesting because in the real estate sector, the disruptions from COVID were fairly brief, and things have really bounced back. And in many ways, certain aspects of the real estate market, certain sectors are back to pre-pandemic levels and really quite strong from both a supply and demand perspective. But the urban cores are really the exception to that. And although people largely did come back to the cities, and that, of course, will vary based on city and demographics within cities, but generally the cities are still way behind where they were 2 years ago in terms of, working and shopping and living. And if you think about in real estate, we've been talking for years about, creating this live, work, play environment. And, work is literally central to that construct. And without the workers coming to the urban core, it really, we don't have the critical mass. And so therefore, retail is struggling, and the business districts seem kind of dead and depressing in some areas. And it just becomes sort of this cycle because the office workers don't want to come back to a depressing business district. And so it's kind of, hard to get out of that until the critical mass is back. And we do think that the cities are going to come back. And in terms of, the urban cores and, large cities, small cities, it's not just Midtown Manhattan or London City where you see this phenomenon where the true central business district just doesn't have the energy that it had, and therefore, some aspects of real estate are struggling. It's also in growth markets like Austin, Texas, and Sunbelt markets like Nashville, where there are actually very vibrant and booming sort of suburban and urban fringe type areas, but the actual central downtown business districts are still, somewhat more quiet than they were. But we really view this as an opportunity, a way to access assets in prime locations, because we do really believe that this critical mass is going to come back. From an office perspective, companies are looking for better, more efficient, modern, very ESG-oriented office space. And really the concept of the office has morphed, from a place where people go to work to a place that now has to the office has to draw people to come back to the office to, put on real pants and uncomfortable shoes and commute to an office. It's not just about kind of shelter and a desk, right? And so the best locations with quality amenities, that was becoming important pre-pandemic. Frankly, there were a lot of trends in that way, but actually, it's even more important now. From a residential perspective, we're seeing some of the best and most forward-thinking residential developers starting to program and design working space within people's units, not just within common areas in the buildings. And actually, surprisingly, we see retail in urban centers and actually more broadly as really one of the least talked about opportunities. And the retail sector obviously was under severe pressure pre-COVID, right? And so people are really talking about the effects of the retail sector from COVID as kind of a version of sort of accelerated Darwinianism, right? And so the sector was revalued a bit prior to COVID. And we really feel that at this point, a lot of the, revaluation has taken place. The creative destruction process has largely run its course. And actually, there's been very, very little supply for the past 3 to 5 years in that sector. So some people might be surprised to hear that we see retail as an opportunity.
Retail in big cities, just to clarify?
Retail in big cities and elsewhere.
All right. A lot to unpack there, and hopefully we can dig into it as we progress throughout the session. Gavin, from your perspective, a lot of people have been looking to the reopening, the getting back to cities, getting back to work as a go-ahead, a green light on the cyclical trade. You've seen a real surge into bank stocks until this week, as well as into airlines and some of the others. Do you think that this has been overplayed, or do you think it still has legs?
Well, first off, hi, Lisa. Hello, everyone. Great to be here today. With this reopening trade, we're very much just in the early days. These cyclicals that you refer to, it has to be remembered, they've been out of favor for several years now. They've taken multiple hits in the past years. Look back to 2018, the trade wars first hit on cyclicals, then COVID hit these cyclicals. And what this has led to are these historic dislocations within markets, very, very big pricing dislocations. And you can appreciate the magnitude of those dislocations if you look at something like the valuation spread, the difference in the valuations between more expensive and cheap stocks in the market. That value spread today is at the 97th percentile. Appreciate just what that means. Those dislocations are wider than 97% of history. And so what that's telling you is that prices have still deviated a lot from fundamentals. There's a lot more opportunity to go with that pricing correction around this reflation trade. And what we've seen historically, when you start to see this take place within the market, this isn't just a flash in the pan correction, 2 or 3 month correction. You see multi-year payoff associated with this. So much more to go there. But probably more so is that when you look within the markets to see where some of these biggest dislocations are, small caps, very attractive there. The value spread is still at the widest level within small caps. And that's not surprising. Many more cyclical names within that smaller cap segment of the market. Now, last year, we did see more signs of that reflation trade starting there in that smaller cap segment of the market. Those cheaper small cap value names did outperform small cap growth names last year. But over a 3-5 year period, those small cap value names are still underperforming. So again, a lot more potential there for outperformance among those names. So we expect stronger reflation trade opportunities in that segment of the market this year. But what we expect to be a little bit different this year is a stronger reflation trade among the larger cap stocks. This was definitely much more muted last year. The market was supported much more from some of those mega cap stocks last year, all the typical Apple, Microsoft, and so forth. But what we're seeing this year and thinking this year is that with the change in position from the Fed, the inflation backdrop, as well, just more optimistic signs that the Omicron situation get more under control, the environment's going to move away from supporting those names, and you're going to see greater signs of those reflation trade opportunities within the larger cap segment of the market too. and just appreciate what that opportunity actually looks like. People think it's a large cap segment of the market. How much of an opportunity is there actually? Well, that valuation dislocation is still very significant there. If you look at large cap growth stocks, they're trading at 35 times earnings compared to 18 times earnings for these cheaper stocks. Very big valuation differential. But look at the fundamentals. This is the key. The earnings growth on offer from these larger cap value stocks is comparable to those larger cap growth stocks. So valuations are supporting that reflation trade in the large cap space. The fundamentals are supporting that reflation trade. And we think the environment is now. So look for more action from that reflation trade in larger caps as well this year.
Gavin, before I let you go on this particular topic, how does energy feature into that, given how much it's outperformed so far this year?
Yeah, it's been an area which has been out of favor for a longer period of time. But energy is also one of those areas of the market where, when those inflation expectations pick up, people do flock towards that as well. So there can be an element of also sentiment continuing to support those names, even if the fundamentals may not be there as well.
So that brings us to you, Brian, which has been one of the biggest areas that's seen such turmoil during the pandemic. And I don't want to say after, because I don't want to jinx us, and hopefully we are after getting to it. But you really focus on this particular space, oil and gas. And I'm curious how private debt and private equity have played such a crucial part, particularly in the shale patch, for keeping some of these companies alive through all the turmoil. And now they're starting to thrive a little bit more. Where are the opportunities that perhaps have not fully been priced back in?
I don't want to tell you because I want to invest in them exclusively. But
come on.
No, so look, one that kind of levels. We invest. Our group invests across the energy spectrum, and we do that intentionally because we want to deploy capital with a holistic view of the sector. I think there's a lot of groups that tend to exclusively focus on a subsector, and so they end up looking at the world through a picket fence, and so they don't see how that kind of all the other factors on both sides of the value chain come into play. Within the conventional energy space, though, and our focus is largely on North America for reasons which you can cover later. These are assets that they've been in the ground for 10 million years. They're not going to rot like a head of cabbage because you don't make a salad out of it right away. So the goal is to try and find a way in this sector to kind of focus on assets with solid intrinsic values, economically durable. And then this was really a liquidity issue for a period of time because we saw obviously kind of this 3 sigma deviation in commodity prices for a period of time. And I think there's no shortage of futurists out there that we were saying it's never going to come back, never going to recover. And you kind of have the emotional constitution of my teenage daughters, like, I'll never love again, best day ever, And so what we try to do is kind of like maintain some level of stability and dialogue with companies. And the winners are the ones, I think, that were able to work directly with management teams to take advantage of kind of institutional trust, and figure out what they were going to do to manage through a liquidity crisis, which is what it was, and avoid making short-term decisions that ultimately, compromise the value of the assets in place. In the commodity industries, there are always going to be some element of Darwinism, and it's good to thin the herd in some ways. But I think the institutions that demonstrated a measure of patience, and that patience was really kind of built on kind of understanding what they had, and having, control over those assets as opposed to kind of just watching things play out in front of them like a movie. Those are the institutions I think that did well. The ones that panicked, the ones that indicated we're out, and they kind of ran for the door, they ended up getting hurt pretty badly during the process. So this is an industry of cycles. If you don't have the temperament to ride out the cycles, probably shouldn't get involved to begin with.
Well, you say, temperament, you need to be patient, and these sort of speak into the whole idea of private markets and longer term capital. From your perspective, going forward after the turmoil and where we are now, is it better to play this from a private debt or a private equity standpoint?
Well, I think you have to kind of understand, one, we have to kind of decouple what's a long-term secular trend versus what's ephemeral, and kind of understand the differences, because that's really what drives where you allocate capital. We do think it is a sector that's going through kind of a measure of, I'll call it, maturity and evolution. The previous decade plus, we saw a sector that was dominated by largely capital gains driven growth for growth's sake. Get in early, monetize, get out. And that's what demonstrating that type of behavior is what attracted capital. I think now we're seeing an industry that's focused more on sustainability, and we can define that any number of ways, but let's just call it production sustainability, and return of capital. People want to know, here's my dollar. What are you going to do with my dollar? How do I get my dollar back? How do I know that you're going to do what you're going to say you're going to do? I think private credit is well positioned to do that, in large part because it has some things in its kind of Batman utility belt for helping them diligence investments and take advantage of asymmetric access to information that you have as a private investor. Deploy technical advisors, reserve engineers, environmental consultants to help us kind of frame up risks and make sure that we try to structure around them. And then we also have control mechanisms, financial covenants. In some instances, we take board seats to make sure that it's more than simply just investing in the company. Kind of from our group's perspective, I would say PGIM's perspective, we get to the Boy Scout motto, kind of leave it better than you found it, right? So what we try to do is make sure that our dollar is valuable, and to the extent that we participate, it will be selectively. We're not trying to fund every energy company, just the good ones, the ones that comport themselves well, and want to make sure that their behavior over the time frame that we're investing reflects kind of our expectations. And then ultimately, short duration, right? I mean, I have pretty good ideas what things are going to look like 10 to 20 years from now, but you shouldn't outdrive your headlights. And so what we try to do is focus on short duration, high contractual yield investments that basically allow us an off-ramp, just in case we're wrong. Every 4 to 5 years, we re-up, decide where we are, and decide if we want to kind of stay in the deal or not.
Well, speaking about energy, it really speaks into the other major issue facing 2022, which is the shift to a greater sustainability, ESG taking on a greater proportion in people's portfolios. Cathy, from your perspective, there has been this shift within the infrastructure of big cities and, frankly, this focus on real estate as far as an emissions footprint. How has this opened up opportunities? I know earlier you were talking about how there is more focus on this. So how do you invest in that?
Well, the first thing that you have to do is make sure you know what you're talking about from an ESG perspective, right? And what the important characteristics are for different property types. And you mentioned, the emissions and essentially the carbon footprints of cities and a lot of these buildings. And I think one of the things that's really changed recently in our sector is that used to be much more of a philosophical conversation, right? And we didn't necessarily have the ability to measure and to very transparently measure and communicate exactly what the emissions are and what the energy usage is and what the water usage is, and the increasing transparency, which is actually very supported by technology, that really has been a game changer within the real estate space, because it's much more definable, and what's definable is more quantifiable. And what we've really seen is that there is, now I can't tell you exactly what it is, but it is evolving, but it's clearly there. There is a green building premium, or you could think of it as a brown building discount, right? That investors and tenants really care about the carbon footprint and about all ESG aspects, including wellness and air quality. That is, really, really important in terms of where we think defining good opportunities going forward from a winners and losers perspective. I mentioned earlier in talking about the office sector, particularly in urban centers, that, the office has become, well beyond just shelter and a desk, right? The office is now more about attracting and retaining the best talent. And so tenants are willing to pay more to be in a building that has wellness features, and that frankly their employees can feel good about working in, and that they feel aligns with their brand and how it is that they are looking at ESG more broadly. And interestingly, at PGIM Real Estate, we recently developed our first carbon neutral office building in the Pacific Northwest in the US. And guess what? It leased up to a high credit, very, very strong credit tech company that is very focused on attracting and retaining the best talent. So from an opportunities perspective, from a resilience perspective, we talk a lot about resilience in real estate. Some cities are much more focused on climate resiliency than others. And for us, we then take that down, one more level to really investing in assets where there is a climate resiliency strategy, either that has already been executed, or we also see a lot of ability to create value by adding that climate resiliency and that sustainability aspect to existing assets.
Just to follow up on that, how much of your portfolio is looking at some of those brown buildings, so to speak, and retrofitting them and making them more compliant versus buildings that actually are already compliant?
So not to be trite, but that's our real estate location, right? So you would really only undertake that in the very best locations, because in many cases, it's extremely expensive to undertake that kind of retrofit, especially if the systems haven't been well updated and well cared for along the way. But there are some locations, you think about Tokyo, you think about Manhattan, you think about, certain central business districts in Europe, where, you can't just create new space, right? So having a greenfield development just isn't necessarily an option in those places, but that's really the only time that really makes a lot of sense in terms of starting from scratch. But you can do little things to increase resiliency and to add an ESG factor. If you have an industrial building, which industrial is obviously very popular right now in our sector, you can put solar panels on the roof, and there you go. You've now created electricity for your building, and you can sell it to the grid. So there's lots of ways that you can add resiliency, add sustainable features without entirely starting over.
And Gavin, this really speaks to your world in terms of ESG as a factor that a lot of people are putting into the asset allocation models. I do wonder how you isolate companies, how you isolate slices of the ESG component that haven't been fully valued after so much money has flowed into areas as some of these gauges become measurable, as Cathy was talking about.
Yeah, that's where you just can't focus on ESG by itself. A good ESG company doesn't make a good ESG investment. And so that's where what we're doing, taking more of a comprehensive investment approach to ESG investing, incorporating other investment insights into the mix. You've got to be looking at valuations. For instance, how much you're actually paying for these good ESG companies. For instance, you want to be identifying those companies where a lot of those ESG benefits are underappreciated. It's also an important point here where you need to also keep evolving how you're thinking about ESG. Certain paradigms, certain approaches to ESG just become out of date or does become pricey. You need to continue looking for new information about ESG that may not be fully priced by the market. So that's where for us we're doing more work trying to look beyond some of just that hard company disclosed data, which is becoming increasingly available. The quality of that is becoming better. And we're starting to look at other information sources beyond what companies disclose directly, other textual information sources where we can be using NLP techniques to try and uncover some more of those unpriced insights. That's some of the approaches that we take to try and unearth those underappreciated ESG opportunities.
Here's the conundrum that I have personally, when I talk to analysts covering ESG, have struggled with. How do you determine what rises to ESG? I mean, Exxon just came out and said that, they're hoping to be net emissions zero by 2050. Does that put them in an ESG bucket, even though they're producing gasoline and fossil fuels, right? I mean, at what point does it shift into something worthy of that moniker? How do you go about defining that to your investors?
Mm-hmm. It can come down to the objective of the strategy as well, and what people want. Some people want an ESG strategy which has a lower risk profile, let's say. So what that means is that within certain industries or sectors, you're tilting towards those companies which have relatively more attractive ESG attributes. So that's where you could still have energy exposure in an ESG portfolio for risk reasons, but you're going to be tilting towards the more attractive ESG players. In a more comprehensive ESG portfolio, you may look to outright exclude some of those names. But something like that situation that you just mentioned with ExxonMobil, where they're putting in place these plans, these targets in the future, it's also how with ESG investing, you have to stop looking backwards with a lot of these metrics and start looking forwards in terms of what companies are planning on doing. markets price off the future. They respond to the future. And so as you start to see those plans, those expectations about what companies are doing in the future, you need to also look at how you can incorporate those future elements into your scoring models. Now, more of that data is becoming available because it does come down to a data issue. I'm a quant. I'm always going to come back to data, but you've got initiatives like the Science-Based Targets Initiative who go out and they validate some of these targets that companies set, increasing the confidence in some of that forward-looking data and increasing the ability to incorporate that into your models. And so again, what that means is that you may override a backward-looking emission measure. They might have high emissions historically, but you may give them a bump, a bit of a reward based on that more attractive glide path looking to the future.
So, Brian, this brings us to you because you're focused on energy, and there's sort of this ironic development as a number of different big institutional investors move away from fossil fuel producing companies. A number of private debt and equity companies have seen an opportunity open up that some of these companies are undervalued in the oil and gas sector, especially as we still rely entirely almost on these sources of energy. Where are people finding an opportunity amid such a delicate moment of transition?
Yeah, no kidding. A massive exercise in cognitive dissonance, right? It's hard. It's really hard. I mean, in institutions, I mean, you could say that, kind of in a joking fashion, but it's a really difficult conversation to have because, institutions and Prudentials and PGIM are no exception, right? They're wanting to be responsive to their constituents. And if you're a retail-facing institution, it's even more challenging because you're trying to convey progress and effort on a very complex topic to an audience that may really want just a simple solution. And simple solutions, it's not Occam's razor. It's not always the right answer. And so what you're finding, some institutions are saying, hey, you know what? I'm out. I'm checking out. I'll see you later. And that's easy to signal to the broader public, but it's not particularly an effective strategy for those that have been studying this issue for as long as we have. It's the question of where do you have the most traction? By completely disengaging or remaining engaged and influencing behavior. Because the issue of fossil fuels, as you pointed out, right? It's 80% of the global's consumption pattern. It's not just a quality of life question. It's life itself, at least currently, right? And so to suggest that withdrawing your capital suddenly changes demand, it's not a very effective strategy. But these are conversations we should have and not shy away from. That's where investment leadership comes from. So what we try to focus on is we don't want to be a bank. A bank, when years ago when I was in banking, it was you wanted to be a little bit to everyone because it was a fee-driven exercise. And so as long as you were participating across the sector, that's where you made money, was all the attendant fees, services. I'm an investor, right? I'm not an advocate for the industry. I'm an advocate for thoughtful and objective thinking. So we say, okay, if we need conventional energy today, and we are investing in solutions that abate demand and give us alternatives, what do we do in the interim, as Gavin kind of pointed out, to focus on, identify, and selectively reward those companies that are making the most progress on something that we may want to move away from, but in the interim, we need. So if you withdraw capital totally, right, what you do is you surrender the market to capital that doesn't really have a standard, in which case you're not making any progress whatsoever. So what we're doing is moving into a market that is being left abandoned on the margin by certain banks that did a poor job managing their book, and certain institutional investors that did the same. In the public market, they'll come back at some level, perhaps not where it was before, but the public market, it has the investment conviction of a windsock. So it'll move back and forth. But on the private side, what we're trying to do is find those areas that we can selectively participate in. We were in here long before ESG was the buzzword. We just called doing the right thing. Now ESG is helping us focus our actions so that it acts as a filtering mechanism. If you look at our portfolio, it's less than 0.1% of the total output. So we don't necessarily move the dial. But where we do see is there are companies, particularly in Canada as well, which has I actually think the United States would benefit from looking at Canada's kind of regulatory policies on energy and abandonment and reclamation issues and emissions, and look for kind of some best practices across the board. Because I think the industry will respond best when we set some constant strike zones. When you see a concern about, you're one election cycle away from the rules being changed completely, what it does is it just locks up capital. It locks up, the activities of the industry and also on potential investors. But we think the credit side is an area where we're starting to see institutions kind of make some headway selectively. And again, with a short duration focus, the entire sector is being repriced from the senior debt to junior capital down to equity. And so that provides, I think, on a selective basis, attractive risk-adjusted returns.
When you say short duration, Brian, I want to get your sense of how long you think, based on the progress that's been made, it will take to develop this transition where fossil fuels do not account for 80% of our global energy consumption. How long would you give it?
The practical reality is someone would say, never will we reach a complete independency. And that's not, again, as an advocate for the sector, but just recognizing that, human beings select things based on a couple of criteria. It has to be abundant, it has to be accessible, it has to be affordable, and it has to be reliable. They apply that decision process with respect to energy selection. They apply it with respect to food selection. It's the reason corn, rice, and wheat represent 60% of our caloric intake, because they're cheap, abundant, storable, shippable, transmutable. Conventional energy replicates those same features. So what we have to do is find a way to reduce the cost and increase the reliability of alternatives. And that's where you start picking it up, because I think a lot of people look at what happens in Europe and the United States, and they apply that to the rest of the world. But the demand equation is going to be driven by the rest of the world. The United States and Europe is on a downward slide. And we can afford alternatives, and we should pursue those. But I think what we have to do is find a way to take those advantages, which will largely be surrounded by cost and reliability, and make them available to the broader world. And that's going to be measured in decades, not years. And so that being said, there's also price cycles and any number of things that create, what call standard risks to the industry that have nothing to do with energy transition that people should be mindful of as well. So we tend to focus on, 3 to 7 year investment bite sizes. And on the credit side, most of our deals are structured that we have clear line of sight that doesn't require an M&A event or some other kind of miracle of the capital markets in order for us to get our money back. And so if you do those things selectively, incrementally, I think you can do really quite well without having to take excessive amounts of risk.
And Brian, when you talk about the rest of the world, it brings us to the emerging markets complex, which has lagged behind the developed world when it comes to emerging from the pandemic. And a lot of people pointing to China in particular with its zero COVID policies and wondering how exactly this is going to work as the world reopens. Gavin, from your perspective, do you think that there are significant equity emerging market opportunities out there this year? And if so, where are the best ones?
And there's broad opportunities across emerging markets this year. And perhaps surprising, because people look at emerging markets last year and say, hey, they underperformed. They were down 2% last year. But you just touched on it, Lisa. Look at emerging markets ex-China. Look at how that performed last year. That was up 10% last year. So there's surprising strength through other areas of emerging markets there. And when you're looking forward in emerging markets ex-China, when you're seeing that improved access to vaccinations, those vaccination rates, some of the early action from the central banks across much of the emerging markets, they're really attractive valuations as well. There's a strong foundation there for some ongoing solid performance across that broader swathe of emerging markets. Now, we touched on China, and we can't ignore that completely. It wasn't a great year for China last year. The MSCI China market was down 20%, and you hit on the head, Lisa. Things like zero COVID there, the government regulations all weighed on the market. But that's definitely being seen as just much more of shorter-term headwinds for the market and seeing more just a shorter-term tactical underweight exposure towards China. When you're looking at some of these regulations, for instance, that the government's been rolling out, and look at what they're trying to do there, one could take the position quite easily that they're trying to achieve more sustainable growth in the economy, more sustainable market performance as well. And so there's these medium to longer term benefits associated with that. And we're clearly seeing many investors take that view with us around that, because over that more medium term horizon, there's a lot of interest in gaining more exposure to that local Chinese market, China A shares, for instance, where you can tap into that local growth engine within China. And from an active management perspective, this is a very, very attractive market to be operating, probably the most attractive market all around the world. And I say that because it's a market that's dominated by retail investors. There's huge information asymmetries on offer there. So a lot of alpha opportunities. It's also a market which is big, very broad, over 3,000 stocks, and surprisingly liquid. So some very attractive opportunities there once you move through some of these shorter term headwinds there around China. But perhaps with some policy stimulus as well, policy action, we saw some of that last night, that could also help change the sentiment towards China quite rapidly. One other area which I'm probably most excited about, coming from my research background, area where I've got more control than a rebound in China, is actually seeing how some new research plays out within emerging markets. We've done a lot of work trying to future-proof our strategies and introduce some new return diversifying insights into our strategies. And so one thing that we've done recently is recognize that what makes emerging markets really attractive is the breadth and dispersion between different countries and industries. A lot of variation, macroeconomic forces, geopolitical dynamics, creates a lot of variation in these returns between countries and industries. Now, what we've done is we've developed this top-down approach that allows us to identify attractive countries and industries. And why that's exciting is it's an environment where we expect this to be very valuable, a lot of those different macro forces at play. But the return opportunities from this, they behave in a way that's distinct from some of your bottom-up stock selection insights. So it complements the rest of our strategies very nicely and helps our strategies perform better across different environments. So really excited to see how that plays out this year, potentially with this backdrop of still some elevated macroeconomic issues at play.
Gavin, just quickly here, I can't ignore the fact that the regulatory concerns and the political concerns and tensions, frankly, between China and the U.S. can complicate the investment thesis there. How are you factoring that in?
So for us, we're not taking big bets on one over the other. It's much more just looking at each country by itself. For us, within China, we're looking much more at those selection opportunities within the Chinese market at the moment, and those selection opportunities within the US at the moment. So not trying to take a big bet either way there, just cognizant of some of those risks at play.
And Cathy, from your perspective, talking about China, I think about some of the concerns recently around property developers, some of the huge hits to debt and equity valuations in response to bankruptcies and new regulations. Is there any potential opportunity here, or is it a no-go kind of zone?
No, we definitely see opportunity in China. And clearly there, as you mentioned, there have been a lot of headlines about China's property sector recently and some of the really big players, but it's largely been focused on the residential sector. And we really think that industrial and logistics in China is an excellent opportunity, specifically development of, new modern assets that will benefit from the growth in China's e-commerce area. China, as we know, is really shifting to a consumption-driven economy, and online sales grew by 23% in 2021. And right now, about 24% of all retail sales in China occur online. And that is as compared to about 13% in the US. So it's a really, really strong e-commerce platform that we think is just going to continue to grow. And they're really, they didn't have enough, and they still don't have enough of modern distribution warehouse logistics space. So we really expect this demand to continue to be there. And development is really where the opportunity is. And back to ESG, we really like assets in particular that have some sort of environmental certification, either a LEED certification or a China Green certification, because ultimately a lot of the buyers of these assets are international investors for whom that's very important.
With warehouse space, Cathy, before I let you move on to the next question, is this property that has been built, or does there need to be warehouse space in China that is newly developed in order to cater to the online shopping craze?
You definitely, generally, not just in China, most places, you want new modern space that is, purpose-built for the types of robotics and the types of conveyors. There are some Amazon facilities that have, like 10 miles of conveyors, within a million square foot warehouse, right? It's just there. It's filled with very, very high-tech equipment, and you really need to be able to accommodate that. You want, the type of loading docks that accommodate this throughput that's very common right now in the logistics space that is really driven by e-commerce. This stuff comes in one side and it goes right out the other side. So to have, modern, very intentionally designed, state-of-the-art warehouses is very important, and in China in particular, given the very, very rapid growth.
So this year has been marked also by inflation. And frankly, seeing a 7% handle on the consumer price index was a real shocker for some, an expected shocker, but nonetheless, the fastest pace of consumer price inflation that we've seen in decades here in the United States. One of the key aspects of analyst reports has been, how do you adjust to that, Brian? That really speaks to your world. How good of an inflation hedge are energy stocks of all sorts, and frankly, debt as well, private debt?
Yeah, debt just benefits from kind of its primacy in the cap stack, and so in some ways, it should do better than equity, although it's the variance of its performance should be a bit more kind of narrow banded. It's a good hedge, and obviously, let's face it, it's commodity prices, whether consumable commodity prices or essential commodities, oil, basic materials, copper, metals, not precious metals. I think gold and platinum are kind of poor commodity hedges, but things that are linked to global GDP and consumption patterns are probably a pretty good hedge. And if you're focusing on investing in the United States, you could say oil is a real good hedge because it's always priced in dollars globally. And so in some ways, if the dollar devalues, it actually benefits the price of oil, at least as it relates to kind of domestic producers. So it's a decent hedge. I wouldn't invest in it just because you think it's a hedge. I think you need to kind of focus on the fundamentals of the business, because you could find yourself well linked to a commodity that's properly calibrated to hedging and still lose money because the old-fashioned way, which the company just does terrible.
So in other words, do you still see in the private capital world upside with respect to inflation? Is that one of the theses driving your investment?
No, it's not. I think obviously, as the industry is demonstrating, it's looking at $80 oil, one with a slack jaw because it's kind of amazed that it's there, but two is a bit of a windfall, and that's probably a good thing. But before, it was an industry that, quite honestly, if it had a dollar in its hand, it wasn't for long, and so because they would put it through the drill bit as fast as they could. Now, whether that's they've suddenly got calcium in their spine and they're doing the right thing because they've had this epiphany, or their investors are basically saying, hey, you know what, I kind of want my money back and show me that you can return. There's a measure of discipline that's being displayed. I honestly don't think the prices where they are sustainable. I think they reflect a kind of a short-term tug on the rope with respect to demand, but the market will respond, and we feel more comfortable finding companies that can still do well at $50 to $60 oil, let alone 80, and hopefully they kind of maintain a capex program that reflects more sustainable development versus growth, and I think you're starting to see that.
Gavin, that's a fascinating point that brings me to you when we look at some of the gains that we've seen in energy stocks and this idea that we're heading toward $100, at least on a Brent level, and probably traded at the NYMEX pretty close to that. So from your perspective, what are people currently pricing into energy stocks, and how do you sort of consider that outlook when you decide where there's still value?
So first off, one of the best ways is going back to, I mentioned at the very beginning, looking at something like the valuation spread, these overall opportunities within the market, those certain segments within the market that can be the better performers in a higher inflation environment. Those dislocations, that dispersion still at historical extremes. So that's a great way of indicating that there is more opportunity to run there. But longer term, the best way to be able to navigate this environment is to be much more discerning, much more selective about identifying these opportunities that can perform better in a higher inflation environment. And that takes me to quality. High quality stocks can perform better in this high inflation environment. And when you're thinking of quality, what exactly do we mean? Because it can be a very broad concept to many people. Well, it's really honing in on looking at some of these ideas around pricing power. Obviously, which of those companies can actually pass on those high costs and potentially increase prices in this environment. We can identify that through looking at things like margins, behavior of margins, high margins. That's a good approach. But also think of what can drive that higher pricing power. could be elements around customer loyalty. So that's where certain insights, even from ESG that we spoke about, could come into play to help us identify some of those high quality companies, those companies that have pricing power. But in this environment as well, it's also important to be looking at those types of stocks that have high degree of operating leverage. That is those companies with high levels of fixed costs relative to variable costs. They're going to be much more cyclical on the upside, can grow sales and not incur high costs. These are names who are going to perform better in this environment. We should also be very cautious about companies who are investing a lot in this environment. Corporate investment is typically a red flag. Companies don't invest well. In general, it leads to a lot of value destruction in the long run. But particularly in higher inflation environments where investing with higher prices, this is a great way to ruin and degrade return on investment capital over the long run. So being cautious of these companies engaging in a lot of investment at this point in time. But one of the just simplest things to be looking at is just focus on companies who are profitable. And this is really steering away from all these zombie companies that have dominated and got many headlines in recent years. A lot of these speculative, idiosyncratic growth type companies, these names who use a lot of debt to pay for things, can barely cover interest expenses. As inflation bumps up, that's going to make it much more difficult for these companies to operate. So focusing just on companies who are profitable as well, and some of these other quality attributes, that's really the best way to be positioned in this environment, be more discerning about selection opportunities and continue to perform strongly.
And Cathy, from real estate's perspectives, a lot of people think about rising mortgage rates leading to a real hit to property valuations. And yet you also are seeing companies buy buildings where there are leases that pay an ongoing revenue. How are you sort of parsing out the inflation hedge versus the inflation hit in a rising rate environment?
Sure. I mean, the rising interest rates for debt that clearly can have an impact on values, but on balance, in real estate, we definitely view ourselves as much more of a hedge against inflation for a variety of reasons. First of all, you mentioned the fact that in many property sectors, and in fact, in many of the property sectors that we think are going to be outperforming in the near term, in industrial, in multifamily, there are sectors where you can pass through the vast majority of any increases in your operating expenses to the tenants. And so it's very common in industrial. If you think about multifamily, you can't necessarily do that entirely directly, but you have the opportunity, at most every year to mark your rents to market to accommodate, those increased costs. The other thing about real estate to remember is that as the cost of development goes up, then the replacement cost on your assets, on an asset goes up, thereby making your existing assets that much more valuable, right? Because to replace them would be so expensive. And it's interesting for us in our sector because I can tell you inflation is not breaking news for us in real estate for, the past, call it at least 5 years. We've seen tremendous inflation in construction costs in both labor and materials. And that has continued, and they've been huge increases. And in fact, just recently we learned of that a lot of the materials that are used for certain roofing systems within the United States, that over the course of 2022, the inflation on the cost of those building systems, those materials, is expected to be 10% per quarter for the balance of 22. So that is kind of the extent of a lot of the inflation that we've seen, which has been, very focused on construction, labor, and materials. Also, general operating expenses. Back to ESG, our insurance costs have gone up tremendously because of a lot of climate issues that we've been seeing, and of course, property taxes have gone up all around the country. So we're kind of fighting an expense battle all around, but fortunately, we are able to pass a lot of those expenses through.
Cathy, before we conclude, where specifically, what regions and what types of buildings do you see as offering the best inflation hedge?
So generally, the best inflation hedge is where you have in my view, a very defined income stream. And I would say that all the stars align right now with industrial assets, logistics outside the US, right? Because generally these are what we call triple net leases, that the tenant is responsible for paying rent and they take care of almost all of the expenses. The other thing that is interesting in industrial is just the incredible rent appreciation and the value appreciation. So the replacement cost is getting high because of the materials costs, but the rent is keeping up, right? So it's a hedge against a lot of new supply because of the increased replacement costs, even though there is quite a bit of new supply right now, but in the future. And the rents are keeping up, and you have the opportunity to have a very stable income stream that generally, if you do a long lease with a high credit tenant like an Amazon, you're going to have built-in rent bumps every couple of years, and you don't have to worry about increases in insurance and taxes.
I just want to thank you all for a tremendous panel. We are unfortunately out of time. The insights are tremendous at such an uncertain moment in, again, the economic and market trajectory. I want to thank Cathy and Gavin and Brian for taking the time. For all of the listeners, if you want to see a replay of the webcast, visit pgim.com. Feel free to reach out with questions that follow up for the panelists or from your representative. And have a wonderful Thursday on this January morning. Take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.